Good evening, everybody. Welcome to this webinar on finance management. I am Anil Lamba, and I look forward to interacting with you for the next 1 hour or so. Folks, we run programs on finance management, and very often a corporate program of this nature is called a program on finance for non-finance persons. And often when I'm doing this program, I love to ask the participants, how many of you in this room are qualified to attend this program? Meaning, how many of you in this room are non-finance persons? Now, obviously, almost all hands go up because they've all come to attend a program called Finance for Non-Finance Persons. And these people may be of marketing background, production background, general management background. Udit, you are saying you're a non-finance person. So when all these hands go up, my response usually is, when I ask you how many of you are non-finance persons, I think not a single hand should have gone up. Now, this raises an interesting question. The participants are saying they are non-finance persons, and I am saying their hand should not go up. There obviously appears to be a problem in the definition, how they are defining who a finance person is and how I seem to be defining. So usually I find it an interesting point to start such a conversation as we are doing today. What do I mean when I say they are all finance people? Nobody, in my opinion, can afford to say I am a non-finance person. So question, folks, is who is a finance person? What is his job? Is it the job of a finance person to track financial information, collect financial data, record that data, collate that data, present that data, to prepare financial statements like profit loss accounts and balance sheets? Is that the job of the finance person? And my answer is no. I think that is the job of the accounts person. So had my question been how many people are non-accounting professionals, then if their hands had gone up, I would have completely agreed with them. But folks, if collecting, recording, presenting financial data is not finance management, then what is finance management? Now I'm going to give you my definition now, which may or may not make absolute sense at this point of time, but I will relate to it as I go ahead. I think finance management is merely the ability on the part of every individual in the organization to understand the financial implication of whatever they're doing. You could be a production person, you could be a sales person, you could be an HR person. You must understand the financial implication of whatever you are doing. I'm sure you're all familiar with a term called bottom line. Now, bottom line refers to the profit. And it is an undisputed fact that every business has started with only one objective, and that is to generate a healthy bottom line. The bottom line has to be positive. That means if the organization is not making profits, it is a failure. Doesn't matter how impressive its vision statements and mission statements might be. And I'm saying finance management is the ability on the part of every individual in the organization to understand the impact of his or her actions on the organization's bottom line. And why should everybody understand how their actions are going to impact the bottom line? So that as far as possible, each person does those things that impacts the bottom line positively and avoids doing those things that hurts the bottom line. And folks, if this is what finance management is, then in my opinion, every individual in the organization whose actions have the power to affect the bottom line is a finance person. So the same people whose hands went up and asked them how many of your non-finance people, I asked them how many of your actions affect your company's bottom line. Again, all hands go up. And then my answer is, when people like you say you are a non-finance person, I kind of interpret that answer to be, you are saying, I don't care how my actions will affect my company's bottom line, but that's ridiculous. You should be doing nothing without first understanding, are you going to strengthen that number or are you going to weaken it? If your actions are going to strengthen the bottom line, do it. If not, don't do it. A very simple example would be, imagine there's a salesperson A salesperson out in the field selling a particular product bumps into a potential customer. Now, typically a salesperson is going to say, I'm a non-finance person, isn't that right? This person bumps into a potential customer. Customer asks him, how much is that product that you're selling for? Maybe he says 50,000 rupees. And this potential customer says, I am interested in picking up maybe 10,000 pieces of your product. But my budget is not 50,000. I cannot go beyond 40,000. If you're willing to accept my offer of 40,000, I'll be very happy to place an order for 10,000 pieces. Now tell me, such offers must be coming the way of salespeople all the while. This salesperson standing in the field is now expected to either say yes or say no to this offer. Tell me, the moment he says yes or no, has he taken a sales decision or has he taken a financial decision? See, he's going to call it a sales decision, but I'm trying to tell you this is finance management in action. You will appreciate if this salesperson's organization could afford a price of 40,000, he has committed a crime against his organization if he says no to this customer. And if the organization could not afford a price of 40,000, he has probably committed a bigger crime if he says yes to the customer. This is finance management in action. I'm trying to tell you, profit of an organization depends upon whether everybody's actions are financially intelligent or not. In fact, the so-called finance people, who are usually accounts people, by the time they come into the picture, you understand the good is already done or the damage is already done. They are actually doing a post-mortem. So the earlier everybody recognizes I am a finance person also, and therefore ensures his or her actions are financially intelligent, the organization's finance management cannot be witnessed. But let me get down to some particular topic today, since this is just a chat with you for an hour on finance management. Let me ask you a question. Now since I can't see you, I can't make it very, very interactive. So I would have asked you how many of you invest in stocks and shares, but I can't see your hands and it will take time if I ask you to send your answers. But some of you might be, some of you might not be. In any case, this session is not about stock market investing, but my question may appear like that. Whether you invest or you don't invest, I'm sure all of you are familiar with the term called IPO. IPO stands for initial public offering, or whenever a company makes a public issue of shares. First issue is called IPO, subsequent ones are not. Imagine an organization is issuing shares, inviting public to invest. And imagine you are invited to invest. Tell me, before you make up your mind to buy or not to buy the shares of this company, you'd like to ask a few questions about this company? You'd like to know a few things about this company? What kind of questions would you like to ask? What would you like to know in order to make up your mind? Would you like to buy the shares or not? Would you want to know, what is this organization doing? What business are they in? You'd like to know the prospects of the sector in which they operate. You might want to know how well they've performed in the past, the past track record. You'd like to know future projections. You might want to know who are the people behind this organization. What is the credibility of the promoter? Himanshu says, I want to know the profit made by them. Yes, in the past. You might want to know future profitability. All these questions are good. But my question is slightly different. Now imagine two people come to you. A comes to you, B comes to you. And both of them say, would you like to buy my shares? And folks, when you ask all these questions that I just asked you, imagine you get identical answers. What are A and B doing? They're doing exactly the same thing. What kind of past history do they have? Their past track record is equally impressive. They plan to do exactly the same thing. So the future projections are as attractive. The promoters are equally credible. The amount of money that they want, what they will do with the money, where they will invest, what product they will make, how much they will make, at what cost they will make, and even the amount of profit they will make is the same. And now if I ask you, would you like to buy the shares of A or B, then your answer is probably going to be, if they are absolutely identical, then how does it matter? You probably say, I can maybe toss a coin and take a decision. But folks, there is one difference between the two. The only difference between A and B is their approach towards where the money is going to come from. Tell me, where does money come from to finance a business? It partially comes from owners. It partially comes from borrowed sources. Owners need not be one or two. If there's one owner, it's a proprietary concern. If there are a few owners, it could be a partnership firm, or there could be thousands and hundreds of thousands of owners in a public limited company. So it can come from share capital. So one company believes in raising a larger proportion of money from shares. The other one believes in taking a larger component from borrowed sources. Whose shares would you like to buy? Would you like to buy the shares of a company where the owner's contribution is higher, shareholders' contribution is higher, or would you like to buy the shares of a company where the borrowed component is more? Can I see some answers? Himanshu, Vijay, Udit, whoever. Devajit, you have a problem with the audio. Rest of you, can you hear me clearly? Just say yes or no, please. Yes. So probably then Devajit, there might be a problem with, yeah, good. All of you can hear. Devajit, then there seems to be a problem either in your internet connection or somewhere in your computer. You might have to check because rest of the people can hear me clearly. Okay, now let's see whose shares should you have bought. Let me put some concrete numbers and ask you again. Let's put small numbers to begin with. Let's say both these companies want to raise 2 million. Later on, we'll add a few zeros and make the numbers more impressive. But right now, let's keep the zeros under control. Both of them want to raise 20 lakhs. Options are, they can either issue equity shares of 100 rupees each, or they have a choice of borrowing, taking a loan which carries a rate of interest of 15%. A says, what I will do, out of the 20 lakhs that I need, I will issue 19 lakhs worth of shares. I will raise 19 lakhs from shareholders and I will borrow a token 100,000. B says I will do the reverse. I will issue shares worth 100,000 and borrow 19 lakhs. Folks, this is where the difference ends and the similarity begins. In their own style, they've raised 20 lakhs. In case some of you are thinking, nobody is going to lend you against an equity of 100,000. Nobody is going to lend you 1900,000. The debt equity ratio is 19:1. I must tell you, the figure of equity that I have given you is of the shares that they're trying to raise. I haven't told you how much is the reserves in the balance sheet of their organizations. Reserves is part of equity if you work out the debt equity ratio. And it is very common that if you have a share capital of 100, there could be reserves of 500,000, sometimes 10 and 20 and 30,000 also. So it's not very unrealistic what I've asked you. Whose shares would you like to buy? Folks, I want your answers. Tell me A or B. Himanshu says A. Okay, now some of you have said A, some of you have said B. Let us see. Folks, I said A and B are identical. Up to what stage are they identical? I told you they are up to the stage of making a profit. But I want to be sure, are you clear in your mind about what is profit? What is profit? Can I say profit begins with sales? And then from sales, if you minus the direct expenses, you arrive at a term called gross profit. Then from gross profit, if you also recover the indirect expenses, you arrive at, this is the stage of profit where you have recovered both direct and indirect expenses except 3. You have still not paid interest to the lender, you have still not paid income tax to the government, and you haven't paid dividends to shareholders. So this stage of profit is either called operating profit or it is called profit before interest and tax, PBIT, or it is called EBIT, earnings before interest and tax, EBIT. Now 3 payments are still left. First we will pay interest to the banker. That gives you PBT. Next, you pay taxes to the government, income tax. That gives you profit after tax. And what do you do with profit after tax? You know, this figure is partially given to shareholders by way of dividend, and partially it goes back into your balance sheet. It is reinvested back into the business, and it appears in your balance sheet under a heading called reserves. Now, some of you would be familiar with all this, some of you may not be. Fault is mine. We've just started abruptly in the middle of some session. So if you're not familiar, just take my word for it. This is the sequence in which things are listed. My first question is, I asked you whose shares would you like to buy? My first question is, tell me which number is the shareholder more interested in? Now, in case some of you are saying the shareholder is most interested in dividend, I will have to say, I beg to differ. Because the shareholder is usually happy if the profit after tax of the organization where he holds shares is a decent number. Now, why is the shareholder more interested in profit after tax and not in dividend? Because the profit after tax, the PAT, belongs to the shareholder. If the company earns a decent PAT, chances are the shareholder would get a good dividend that makes him happy. But in the event they do not give a very high dividend, in the event a larger proportion goes to reserves, sometimes that makes the shareholder happier. Why? Because when profits go to reserves, something called the net worth of the shareholder goes up. When the net worth of the shareholder goes up, there's a term called book value. The book value of the share goes up. When the book value of the share goes up, the stock market value of the share goes up. So either way, the shareholder stands to benefit, either directly by way of getting a higher dividend or indirectly through an appreciation of the capital market investment of this person. So a shareholder is happy if the PAT of the organization where he holds shares is an impressive number. I said A and B are identical. Tell me up to what stage will they remain identical? Sales will be the same. Direct expenses will be the same. Gross profit therefore will be the same. Indirect expenses will be the same. PBIT will be the same because they're identical companies. But folks, the similarity will have to end at PBIT level because their borrowings are different and therefore the interest obligations are different. So do you appreciate any comparison that I do between A and B? I can begin latest at PBIT level. So let me start with PBIT level. Folks, how much is a decent PBIT on investment of 20 lakhs? I think a business should earn a 30%, let's say, is a pretty good average. So let's imagine both are generating a PBIT at the rate of 30%. They have invested 20 lakhs. Both of them are earning 30% of 20 lakhs, 600,000 as profit before interest and tax. Now we need to pay interest. So how much has A borrowed? A has borrowed 100,000 at the rate of 15%. So the interest that A will pay will be 15,000. B has borrowed 19 lakhs at 15%. So the interest obligation will work out to 285,000. The resultant figure is called profit before tax. In the case of A, it will be 585,000. In the case of B, it will be 315,000. Next comes income tax. I'm going to round it off to 40%, even though in India today it's a little lower than 40%. At 40%, A will pay 234,000, B will pay 126,000, and that gives you profit after tax, which will be 351,000 in the case of A and 189,000 in the case of B. Now let's expand the numbers. Let's add a few zeros. Folks, had you bought the shares of A, the profit that belongs to you would have been about, let's say, 360 million. And had you bought the shares of B, the profits that belong to the shareholders would have been approximately 180 million. Question is why? Non-finance people are convinced profit is the automatic result of the ability to make and sell. So here are two companies having identical ability to make, identical ability to sell. They've invested the same amount. They bought the same machinery. They've hired the same number of people. They manufactured the same quantity at the same cost, sold at the same price. Then how is it that the owner of one company earns not 5% more, not 10% more, not 50% more, 100% more than the other? Whose shares would you like to buy, A or B? Now, if you have said now A, my next question would be, have you heard of a term called EPS, earnings per share? How much are the earnings of A? A has earned 351,000. How many shares does A have? If you look at equity shares up there, they have 19 lakhs in shares. Each share is 100 bucks. So the number of shares are 19,000. 19,000 shares of 100. Earning per share works out to 18.47. In the case of B, the earnings are 189,000. The number of shares are 1,000. There are 1,000 shares of 100 each. The earning per share works out to 189. My question remains the same. I first asked you, how can one company earn 100% more than the other? Now I'm asking you, how can one company earn 1,000% more than the other without doing anything different? Folks, had you bought the shares of A, for every 100 bucks invested by you, you would have earned 18. In the case of B, for every 100 invested by you, you would have earned 189. Why? Now, rest of the time that we have, we'll find answers to this. Why do you think B earns more? How many of you are right now thinking B is earning more because the number of shareholders is less? Imagine every shareholder has just got one share. So how many shareholders are there in A? 19,000. How many shareholders are there in B? 1,000. Are you thinking that B is earning more because the number of shareholders? Sanjeev, B is of course earning more in terms of earning per share. So I was asking you, do you think B is earning more because the number of it is having less shareholders? That's exactly my question, Sanjeev. Answer is no. It doesn't matter how many shareholders there are. I gave you an example saying it's a shareholding company so that I could involve you in the example as shareholder. But imagine there's a single shareholder. There's a proprietary concern. How many owners in A? 1. How many owners in B? 1. How much did Mr. A invest in his business? He invested 1.9 million. And how much did he earn? He earned 351,000. So what I have written as EPS, I could easily have written as return on investment. They have earned an 18% return on investment. B has invested 100,000. On 100,000, he earns 189,000. Return on investment is 189%. Himanshu, therefore, had you invested in A, for every 100 invested by you, you would have earned 18. In the case of B, for every 100 invested by you, you would have earned 189. So the question to be answered is, why do the shareholders of B earn so much more? Tell me, where are they similar and where are they different? We said sales is the same. What does it mean? It means both the companies' sales department must be same. That means their selling cost must be same. What else is same? Direct expenses are same. That means their cost of production must be same. That is why gross profit is same. Their indirect expenses are same, which means their administration costs, their HR costs must be the same, which is why PBIT is the same. But gentlemen, the difference is only in the cost of money, financing costs. You know, I jumped into this session because this is the first time we are interacting. I haven't, had you attended a proper course, I would have taken you through it systematically, and one of the first messages would have been, if you ever attend a session of mine on good finance management, which is there on WizIQ if you ever want to do it, we have discussed over there that absolute fallacy is, the biggest misconception people have is owner's money is free. Whereas the truth is, owner's money is far more expensive as compared to borrowed money. You can easily borrow at 10%, 12%, 14%, 15%. But if you are an owner of the business, folks, I would never ever invest in a business if I'm going to earn 10, 12, 14, 15%. Tell me, if you get a choice of keeping your money in a bank and earn 5 or 10% and doing a business where you can earn 5 or 10%, which option will you choose? Obviously, we will choose a bank because bank investment is safer. Why would I want to put my money in a business, take a risk and earn the same that I would have earned there? So number one, you will only invest in a business if in a bank FD you can earn 8%, 9%, 10%, then in a business you should earn at least 15, 18, 20%. Number two, if you invest in a safe area like bank, like bonds, like maybe even stock market, you see, when you invest over there and whatever returns you earn, but you get the returns by doing no work at all. You have invested your money and are sitting at home and earning. But when you invest in a business, you not only invest money, but you go and then you physically work over there from morning to evening. And then you take all the tensions of running a business. Don't you deserve another 5, 10, 15% for that? So I'm saying, if safe investment can earn you 10%, business should earn for you 20%. In safe investments, you are not doing any work. In business, you are putting in effort, so you should earn still more. Safe, here there is a risk in a business, you should earn little more. So I'm saying a business must earn for the owner a minimum return of 30, 40, 50%. Only then a business is justified. Now, before you get horrified that no business can earn 40, 50%, I must tell you, I'm not talking about a margin on your cost. I'm not saying if you buy a product for $100, you must sell it for $150. No, I'm saying your return on investment should be 40, 50%. If you buy a product for 100, you can probably sell it for 101. How much have you earned? 1%. But if you release the money the next day and you buy again and sell it again and earn again 1%, and next day you buy some more and sell it again, if you rotate your money more number of times in a year, even if your margin on your cost of the product is as low as 1%, you can earn 50, 60, 70% return on investment. If what I've said just now is not clear, it's only because I've tried to explain in 2 minutes what should have taken maybe much more, but that is there in some of our other sessions. If you ever get a chance to sit through another session, I will systematically explain this to you. Today, take my word for it. So I'm right now, my limited objective is to tell you that owner's money is far more expensive as compared to borrowed money. What is the difference between A and B? One has taken a larger proportion of money from the owners. The other one has taken a larger component from borrowed sources. Expensive money is owner's money. Cheap money is borrowed money. So in case of A, what percentage of money has come from an expensive source? 95% of his money has come from an expensive source. 5% has come from a cheap source. In the case of B, 5% of his money out of 2 million, 100,000 has come from owners, which is expensive. 1.9 million has come from borrowed sources, which is cheap. Assumption, of course, is PBIT is 30%, which is not at all an unrealistic assumption because that is the homework you're supposed to do before you start the business itself. Folks, if you can't earn 30, 40, 50% PBIT, I don't think you should have started the business. Folks, what I'm trying to tell you is B earns 30% on 2 million. What does it mean? It means B earns 30% on his 100,000, but B also earns 30% on the borrowed 1.9 million on which he is obliged to pay only 15%. And what happens to the difference of 15%? It goes to the pockets of Mr. B. So how much money is Mr. B taking home? B is taking home 30% on his own 100,000 as well as 15% of the borrowed 1.9 million, his own rate of return shoots up. Second reason why B earns so much more, I'm going to discuss three reasons. Second reason is, tell me, when you take money from a loan, what is the cost called? Cost is called interest. When you take money from owners, what is the cost called? The cost is called dividend. In this hierarchy that you see in front of you, PBIT 30% less interest, PBT less tax is equal to PAT. In this hierarchy, where does interest appear? Interest appear earlier on. After interest, what happens? You pay tax. And then what happens? You pay dividend. So after paying interest and before paying dividend, one has to pay income tax. What does it mean? It means interest is pre-tax. Dividend is post-tax. Interest is a tax deductible item. Dividend is paid out of after-tax profits. So imagine you are a shareholder of B. And you go to Mr. B with a complaint that, B, what are we doing? Our organization is earning a PBIT of 600,000 and almost half the profit, 285,000. You're paying away as interest, and interest is paid to outsiders. And it starts hurting you. And why does it hurt you? Because you're comparing yourself with your next door neighbor A. And you tell Mr. B, look at A, he's so smart. How much money does he give away to outsiders as interest? Only 15,000. By implication, you're saying bulk of the profit Mr. B retains for his own shareholders. So folks, you as a shareholder of B, go to Mr. B with a complaint and you say, Mr. B, if there was some way in which even we could avoid paying 285,000 to outsiders, you know, we the shareholders of B would have been richer by 285,000. Is that a correct statement or a wrong statement? If B did not have to pay 285,000 as interest, would not the shareholders of B be richer by 285,000? Answer is no. Why not? Folks, if B does not pay 285, the figure that will go up by 285,000 will be the PBT figure. And if PBT goes up by 285, the income tax liability of this organization would have gone up by 40% of 285, and what would have gone to the pockets of Mr. B would have been 60% of 285. What I'm trying to tell you is, whenever the Income Tax Act of a country says, we shall allow so and so item to be tax deductible, what they're saying is, gentlemen, liberally spend. Because imagine, what are tax deductible items? You know, for a business organization, for a manufacturing organization, the raw materials that they purchase are tax deductible. The salaries paid to employees is tax deductible. Business related traveling expenses are tax deductible. Interest on loan is tax deductible. Imagine on such items an organization does some economizing. They do some cost cutting. They do some cost control. And let's say this organization spends about $100 less on such an item. What will happen if they do not spend 100 on this item? The PBT of their organization will go up by 100. And if the PBT goes up by 100, the income tax liability will go up by 40. And what will come to the pockets of this organization will only be 60. Tell me, when this organization did not spend 100, how much did they become richer by in their pockets? They became richer by 60. And had they spent this 100, how much would they have become poorer by in their pockets? They would have become poorer by 60. Who would have become poorer by the remaining 40? The government of the country. So I am trying to tell you, whenever the government says we shall allow so and so item to be tax deductible, what they are urging the people to do is to liberally spend. The government says, folks, for every 100 that you spend, you contribute 60, we will contribute 40. Folks, interest is tax deductible. Dividend is not tax deductible. What does it mean? it means I've already been on record having said that according to me, even a 15% loan is cheap compared to the cost of owner's money. Now I'm telling you it's not cheap, it is actually cheaper. Because for every 100 that you borrow, on which you commit to pay 15 as interest, actually you are not paying 15. You are paying 60% of 15, that is 9. The government of the country is paying 40% of 15, that is 6. So a 15% loan, net of tax, actually costs you 9%. So can you imagine if somebody had borrowed at the rate of 10%, the loan would actually cost them 6%. So ridiculously cheap. And now you realize Mr. B has borrowed 1.9 million, 95% of his requirement of money. 1.9 million has been borrowed at a rate, at an effective rate of 9%, but this company continues to earn 30%. That means they earn 30% on Mr. B's 100,000, but they also earn 30% on the borrowed 1.9 million, on which they are obliged to pay just about 9%. 21% of 1.9 million plus 30% of 100,000 goes to the pockets of Mr. B, and that is what takes his rate of return shooting upwards. But there is a third and the most important reason why B earns so much more. Now, since we'll be running out of time soon, I'm going to be a little fast, but if you don't understand something, please ask me. And to explain the third reason, I'm going to ask you another question. You know, my experience is most sales-driven organizations. You ask a senior person of a sales-driven organization, how much is the sales of your company? What is the top line of your company? You ask them this question today morning, they'll probably give you the number of last evening. They monitor the sales figures on an online basis. But you ask the same person, do you know your top line? Do you know your sales? He says yes. And ask him, do you know your bottom line? Do you know your profit? That is usually a black hole. They don't know whether the organization has made a profit or a loss till the accounts department completes the profit loss account and the balance sheet. Gentlemen, this I find scary. In my opinion, all aware organizations, all senior people in those organizations, all entrepreneurs must not only be aware of the top line at all points of time, but by looking at the top line, they must know the bottom line. Today, I will not have time to teach you tools and techniques to do so, but I'll set some kind of an input I can give you. But, you know, normally you have to wait for accountants to tell you, and that takes a long time. But to take intelligent decisions, you must always have an idea where do you stand. So let me ask you the question. You know, historical information you already have. You always have. So let's say last year this company's sales turnover happened to be 100. And this company's profit was 20. This is last year's information. Now this year you are monitoring the top lines. And this company's top line has become 200. Last year, how much was the sales? 100. How much was the profit? 20. This year, how much is the sales? 200. Can you guess this organization's profit? Now, I'll give you three options. If sales of 100 becomes 200, profit of 20 may become 40. Second possibility is it might have become less than 40. And the third possibility is might have become more than 40. Which school of thought are you from? Do you think if sales of 100 becomes 200, profit will become 20 will become 40? 40? Greater than 40, Sanjeev says. Does anybody think it will become less than 40? Himanshu also says more than 40. I completely agree with you, Sanjeev and Himanshu. Because if this company's sales of 100 becomes 200, good Vijay, good. Udit had also said 40, more than 40. Folks, if the sales goes up from 100 to 200, if the profit of 20 had become less than 40, some people should not be around. Some people are bungling up badly. And therefore, I completely agree with those of you who said profit will become more than 40. But the next question is, how much more can it become? Suppose 100 becomes 200, do you think 20 could also become 60? And if you say yes to 60, my next question will be, can it become 80? And if you say even 80 is possible, the next question would be, do you think it can become 100? Or do you think it can become 120? Now I've run out of space. And the answer is, if sales of 100 becomes 200, profit of 20 can become 40, can also become 60, even 80 is possible, even 100 is possible, even 120 is possible, but more than 120 is not possible. Soon I'll give you the logic behind it. But right now I want to ask you, out of these last 5 columns, 40, 60, 80, 100, 120, 2 of them are theoretical, 3 are practical. 2 of them are remote possibilities, 3 are in the realm of reality. Which 2 are remote possibilities? Folks, if 100 becomes 200, 20 becoming 40, and 20 becoming 120 are both remotely possible. Sanjeev and Udit, 120 is correct, and the other option is 40 is also not possible. Or let's say it's possible only in theory. Now let me give you the logic. Logic is very, very simple, folks. You know, when I told you sales is 100, profit is 20, what I have effectively told you is that my cost is 80. Now when sales of 100 becomes 200, when will the profit of 20 become 40? It will only happen if cost of 80 becomes 160, which will not happen. If sales will double, all costs will not double. Similarly, when sales of 100 becomes 200, when will the profit of 20 become that last column of 120? It will only happen if the cost of 80 continues to remain 80. That is also not going to happen. In other words, folks, if sales doubles, neither will no cost double nor will all costs double, and therefore the reality has to be in between those 3 columns. Now tell me, where did I get this data from for the first column? That data I must have obviously extracted from a financial statement called a profit and loss account, P&L account, where that sales of 100 must have appeared on the right side of P&L account. And the cost of 80 is the total of the left hand side, which must have included items like raw materials, power, salaries, commissions, rent, and many, many, many more items. The total of this must have been 80, the profit must have been 20, and this I have condensed and given to you in that column number 1. And what question did I ask you? Question asked was, what if the sales of this company goes up from 100 to 200, what will happen to profit? Tell me, folks, if sales of 100 becomes 200, what is the possibility that for 100 sales this organization spent 45 on raw material? What is the possibility for 200 they will consume raw material of 90? Very, very strong. For 100 sales, if the power consumption was 5, for 200 can it become 10? Answer is can. Gentlemen, when the sales was 100, they were giving a salary of 9. If they sell 200, will they increase the salary to 18? Answer is no. There could be small increments. Or if I had asked you not year 1, year 2, but if the data given was month 1, month 2, then 9 of salary can remain 9. Isn't that right, Vijay? And folks, when people brought you business worth 100, you gave them a commission of 10. If they bring you business worth 200, will you give them a commission of 20? Answer is of course. Commission is proportionate. And when this company's sales was 100, the rental happened to be 11. If they sell 200, will you pay 22 to the landlord? Answer is no, rent will remain 11. Or what I'm trying to tell you is, if you start studying all your heads of expenses nature-wise, you are going to discover against every head of expense, you will be able to write either the letter V for variable or the letter F for fixed. All your expenses can be broken up nature-wise into either variable or fixed. And now when I ask you that original question, sales 100, cost 80, profit 20. If sales becomes 200, guess the profit. You should tell me, Anil, if you want me to guess the profit, please give me the breakup of that 80. How much is V and how much is F? And folks, only if I had told you the breakup looks like this, everything is V, no F, which is not going to happen. Only then, if sales of 100 becomes 200, variable 80 will become 160 and profit will become 40. But what if you were told the breakup looks like this? Folks, if the breakup is 60 variable and 20 fixed, now when 100 becomes 200, variable 60 will become 120, fixed 20 will remain 20 and profit will become 140. And what if the breakup look like this? And what if it look like this? And only if it look like this, which is not going to happen. But the question I want to ask you is, can you please tell me, when do organizations make more profit? When the fixed costs that they have to bear are less or fixed costs are more? Now chances are, if you said, my question is, lower the fixed cost, higher the profit, or higher the fixed cost, higher the profit? Some of you might be saying, lower the fixed cost, higher the profit. But this chart seems to tell you, when the fixed cost was 0, as in that second column, when sales of 100 became 200, profit of 20 became 40. But when fixed cost was 20, profit jumped up to 60. When fixed cost was 40, profit jumped up to 80. And in the last column, where the fixed cost is 80, all your costs are fixed, the profit of 20 became 120. So Sanjeev Avasthi, you're absolutely right. Where fixed costs are more, profit is more. But this statement may not appeal to common sense. I seem to be saying, higher the fixed cost, higher the profit. So what is the suggestion to employers? That tomorrow morning you should shoot out a memo to your employees saying, I want to double the salary of everybody because we are told higher the fixed cost, higher the profit. Don't do that. If you increase your salary unilaterally, if the cost will go up, profit will fall. Suggestion is not that you ring up your landlord. How much rent are you charging me? Can you charge me a little more because I want more fixed costs? For heaven's sake, don't do that. If your cost will go up, profit will fall. Gentlemen, common sense thinking seems to tell you, lower the fixed costs, higher the profit. Then what do I mean, higher the fixed costs, higher the profit? You watch those last 5 columns again. And before that, the first column. Imagine these last 5 columns belong to 5 different companies. They are actually 5 different companies. I'll just extend the session by about 10 minutes. Folks, imagine those. This is company A, B, C, D, and E. Last year, imagine all 5 of them had a profit loss account looking like the first column. All 5 had a sales of 100, cost of 80, profit of 20. But the difference between the 5 of them was the breakup of that 80. In the case of A, what is the breakup of 80? All 80 is variable, no fixed. In the case of B, 60 variable, 20 fixed. C, 40-40. D, 20-60. And E, no variable, all fixed. Folks, between A, B, C, D, and E, who has the least fixed cost? A. Who has the highest fixed cost? E. Next year, all 5, A, B, C, D, and E, all 5 work twice as hard. And they double the turnover of 100 to 200. When Mr. A's turnover doubled, what happened to his profit? Profit also doubled from 20 to 40. When Mr. B doubled his turnover, his profit trebled from 20 to 60. In the case of C, profit quadrupled. In the case of D, there seems to be a little typing error in C, that profit should be 80, not 30. Just notice that, please. In the case of D, it has quintupled to 100, and in the case of E, it has gone up to 120. Folks, between A, B, C, D, and E, who has the highest fixed cost? E. Whose profit jumped up the most? E. Moral of the story, higher the fixed cost, higher the profit. So why am I saying then don't call up your banker? Are you charging me 12% interest on my loan? I want to pay 15%, don't do that. If fixed cost will go up, profit will fall, then how do I mean higher the fixed cost, higher the profit? Tell me, between A, B, C, D, and E, who has the least fixed cost? A. Who has the highest fixed cost? E. But have you noticed? The cost of all five is 80. E doesn't have a higher cost. E has a higher fixed cost. Folks, what I'm trying to tell you is, if you unilaterally tomorrow announce a raise in salary or pay more rent to the landlord, cost will go up, profit will fall. Trick is, cost should not go up, fixed costs should go up. And how can fixed costs go up without cost going up? Answer is, in which case what you must do is you should start exchanging a variable cost with a fixed cost. Let me give you the logic behind it first. Why does profit go up more when fixed costs are more? You see, what does the graph look like? If all your costs are variable, if sales goes up, costs will also go up in the same proportion, profit will also go up in the same proportion. If sales increases by 10%, profit will increase by 10%. If sales doubles, profit will double. Sales of 100 becomes 200, profit of 20 will become 40, provided there are no fixed costs. But what does a fixed cost graph look like? Fixed cost graph is a straight line. It doesn't remain straight forever. Fixed costs also go up, but when fixed costs go up, they go up with a jerk, so it's kind of a step graph. But in this phase, while the fixed costs do not go up, in the initial phases, if your fixed cost is very high, there could be chances are your revenues are even lower than fixed costs. That is the phase where organizations make losses. But as the revenues start rising, you reach a point called the break-even point. And thereafter, if revenues continue to rise, fixed costs being fixed in nature do not rise. Successively with every jump in sales, your profit goes up at a faster pace. We are not discussing it today, but this phenomenon in financial language is called the leverage effect. Some other day we can discuss leverages separately. It's a fascinating topic. So folks, tell me, why do profits go up faster when fixed costs are more? Answer is, the beauty of fixed cost is, as income starts rising, costs do not rise, and therefore the profits rise faster. Problem of fixed cost is, if income start falling, fixed costs also don't fall, and profits come down sliding equally fast. So highly leveraged companies are highly risky companies. And lesson we need to learn from this is, what strategy should you adopt if you want to maximize profits? And the strategy seems to be, in good days, in boom times, where business is there, try and exchange wherever possible variable cost with a fixed cost. But when recessions set in, you should do the reverse. Start an exchange of fixed costs with a variable cost. So finance management has to be a dynamic subject. You have to react according to situations.